We're going to call to order the Finance and Audit Committee regular meeting for Thursday, February 23rd. If you would please call the roll.
Good evening, everyone. I'll begin with Director Weber.
Present.
Jones.
Here.
And Chair Wood.
Here.
Turning it over to you.
Thank you. Right now is the public opportunity to discuss matters of public interest within the committee's scope, including items on or not on the agenda. Do we have any comments or any speakers?
We do not have any speakers in the audience. And Art, do we have any speakers in our virtual audience?
Not today.
All right, thank you. We'll move on to consent. Do I have any questions on the consent?
No questions, Mr. Chair. I move consent.
A second.
All right, would you call the roll, please?
Director Weber.
Here. Or I, excuse me.
Jones.
Here. Oh, aye.
And Wood.
Aye.
Motion passes.
Thank you. Moving on to presentation items. Our first is the mid-year budget for fiscal year 2022-23. Mr. O'Toole.
Thank you, Mr.
Welcome.
Chair
Thank you.
and board members, Fire Chief Haverty, colleagues, and members of the public. Tonight, I will be presenting the 22-23 mid-year budget. And this uses the actual numbers for the first 6 months of the fiscal year and projects for the subsequent 6 months.
I don't think the mic's working for you.
Closer. Is that can you hear me?
We don't use the microphones for the Zoom component. You're talking about the,
I can't hear Dave.
okay.
I'll speak up.
Thank you, Dave.
Yeah, for tonight, I'll be presenting the 22-23 mid-year budget, and which uses actuals for the first 6 months of the fiscal year and then projections for the subsequent 6 months. Before I begin, I want to be clear that the mid-year budget presented tonight is balanced and does not include any reductions. To show you how we arrived at this fiscal condition, I will begin by discussing all 7 funds with the revenues and expenditures and transfers for each. And then we'll move on to the general fund, looking at 3 fiscal years, as well as including the final budget and the mid-year differences. Next, we'll look at costs associated with the MOU, which of course was an additional cost that came after the final budget. Then we'll look at 2 IGT programs, intergovernmental transfer programs, the voluntary rate range program, and the public provider ground emergency medical transport program, and how those relate to our budget. Then we'll look at 3 structural budget challenges facing the district, and then I'll close with a wrap up of takeaways and your questions. There we go. Okay, so this is a overview of all funds. Our 7 funds are featured across the top there, the general capital facilities and so forth. And then on the left-hand column, you have beginning fund balance as of June 30th. So that's what we started the fiscal year with. And then during the year, there was revenues and expenditures. Revenues came in, expenditures came out. We had transfers, and then we had a change in fund balance. And then at the bottom is the ending fund balance. So a way to look at that, I want to be clear on this slide because it's combining 2 different features that we had that we have in our actual mid-year budget. The shaded horizontal line at the top there, you would think of that as your savings account, and the shaded line at the bottom, think of that as your savings account. And then your checking account would be the lines in between, where you have, if you use your checking account this way, you'd have your payroll come in into that account, and you pay out your mortgage, groceries, or so forth. It's the activities that are happening during the fiscal year, which are separate from the account, the savings account that you have. So I'll give you, I'll show you a specific example. We can just start with the general fund there. So we anticipated at the start of the fiscal year that we'd have a balance of 34.7 million. Revenues came in at 254.5 million. Expenditures, as of this mid-year, of course, are at 264.8 million. We have net transfers in of 11.6 million, and that leaves us with a change in fund balance of 1.4 million. So if you look at the beginning balance is 34.7, you add in 1.4, that we increase our ending fund balance to 36.1 million. The capital facilities fund has no revenues, but in expenditures of 21 million. We did have transfers into the capital facilities funds of 13 million. which leaves you with a change in fund balance of negative 8 million. That doesn't mean that the balance is 8 million, because of course, if you can think of the savings account example again, you had 9 million to start with, you end with a balance in the savings account of 1.1 million. Now, just to explain that a little bit, because it does look, it may appear a little bit odd, is we finance quite a bit of our apparatus, and for accounting reasons, we recognize the full cost in the first year. So that 8 million won't end up being 8 million, but we have to show it for accounting reasons in our budget. The leased properties, grants, and development impact fees fund. You can see how the savings account barely changes from beginning to end there. So much of what money is coming out is coming in is going out and staying about even. The IGT fund there started very low at a balance of 76,000 in there. We expected all the IGT funds that come in, which include that VRRP and the PPGEMT we'll talk about later, that will all be spent. This new one, the Special Projects Fund, it's a Zinfandel training site, as you think you know, and you'll be hearing in a later agenda item. There was an appropriation of $13 million to Cal OES. We're able to draw down on that $200,000 that's there, that's coming in and being spent. We expect that to go towards project planning. We'll take us to our next slide. So now, as I said, we'd be focusing on the general fund a little more. There are the two prior years from 2021 and 21-22, and then there's your final budget numbers, which we approved in September, and then the mid-year column and the variance. Just focusing on the variance, if you will, you can see that property tax stayed fairly flat. There was a slight adjustment we learned of in January, reduced our property taxes by about 200,000. Charges for services slipped by about 3.1. A large part of that is EMS revenues, which I'm going to talk about in the subsequent slide. Other revenues went up by 500,000. So you get a net change in revenues of 2.8 million, lower than what we had in the final. On the expenditure side, labor costs went up about almost 8.2 million. That's a combination of a few things, but probably the biggest pieces would be the MOU and constant staffing. Service and supplies increased by about 1 million. Two big pieces to mention there would be diesel fuel costs and the kitchen repairs for the fires at the two stations. Some other expenses reduced. So our expenditure total went up by 8.2 million relative to the final budget. And then the net transfers, we saw a gain in net transfer of almost 8 million. So the mid-year budget relative to the final, there's the change in fund balance was 3.2. We're still seeing it's effectively a 1.4 gain over the prior fiscal year. So major changes since the final budget, just focusing on the revenue side first. Again, there's a small change of 200,000 in the property tax collections. In the IGT, voluntary rate range program, we saw 1.7 million additional come in after the final budget. We learned after the final budget. So the PPGEMT also, we did not build that into the final budget. The pieces came together after September. We anticipate about 9.9 million coming in for that. Although there is an offset for contributions that we have to make to pull down that money, which is in the next slide. The EMS revenue, we expect an erosion of 2.5 million. Now that's based on transports. We're seeing about a 6.5% reduction in transports relative to what we had built in. Incidentally, the calls have not declined. There are slightly more calls than last year, but the transports themselves have declined. So here's on the expenditure side in the general fund. The services and supplies, again, increased by 1 million. We have the PPGEMT match. So that is the amount that we have to put up to the State Department of Healthcare Services to be able to pull down that 9.9 million I mentioned. So you really get a net gain of 5.4 million. Constant staffing callback increase is substantial, but 7.1 million. We have a subsequent slide on that. Workers' compensation cost increase also went up 4.8 million relative to what we had built into the final budget. On the positive side, we have some vacant position wage savings. So as you know, we budget all positions as full when we build the final budget. Mid-year, we take a look at it and we determine what positions are not going to be filled and can we recognize those savings now. So we recognize about 1.4 million in this mid-year budget. We also have some other costs that came in under sick leave buyback, medical plan savings, renegotiated medical plans, and some CalPERS cost reductions relative to what we built in, savings of 2.7 million. So that's the expenditures for the general fund. Looking at MOU costing, this is a figure you're familiar with, but as I mentioned earlier, it was a big additional cost on that was added after the final budget. So I just wanted to include a slide on that. The total we built in was 5.8 million, includes about 3.6 million in wages, $600,000 a month is the additional increase approximately. Constant staffing increase by about 1.1 million, other incentives and qualifications and so forth. At the bottom of the slide there, just note for future reference, the 23-24 cost to implement the MOU will be about 15.2 million. That's what we estimated when we costed it out. And then 24-25, we think it's about 19.4 million. And this slide is the intergovernmental transfer programs that I mentioned before. So there's two. And for a long time, when we've said IGT, intergovernmental transfer, we've just meant the top one there, the VRP. The PPGEMT, apologies for the alphabet soup, is a very similar program. It operates the same way. We put money up and to DHCS, they match federal funds, it gets pulled down. So we are putting this new PPGEMT program into the IGT fund because it operates the same way. And hopefully we can shift away from calling it the IGT and be a little more specific when we need to be. Is it VRP or is it PPGEMT? All those letters will just roll right off. Let's see. Okay, so we'll start with the VRRP, also named IGT, as I mentioned. It combines local agency funds to pull down federal funds. The most recent district transfer amount was 5.5 million. That's how much we had to put up. We also had to put up a 20% administrative share that the DHCS receives pursuant to statute. They get 20%. So we contributed 6.6 million. And once that money is secured, once the DHCS has secured that money with the federal agency, they transfer to private managed care providers who accept their share and then wire the rest to us. So as noted there, a net gain of 10.4 million is what we will receive this fiscal year from the VRRP program. On the public provider ground emergency medical transport program, the net gain is a little smaller, 5.6 million. And how it operates is pursuant to AB 1705 of 2019. It replaced the GEMT program we've talked about before. It actually had two components noted there: the quality assurance fee and the certified public expenditure, which expired December 31 of last year. And the next day, PPGEMT stood up and replaced the flat payment per Medi-Cal transport. It moved it up to 1065, which is approximately $947 higher than the previous rate. So a good solid gain for the department. DHCS also charges an admin fee for this, although it's only 10%, not 20%. So less those DHCS fees, the federal funds equate to approximately $2.16 for every dollar we put up. That's this fiscal year. That number will change a little bit every year, but I thought it'd be a good reference for now. Next, I wanted to talk about some structural budget pressures. So this is not, these are not built, described in any great detail in your budget, but more for your information is, as the Finance and Audit Committee, something to be thinking about. So there's three: constant staffing, workers' comp costs, and declining non-general fund balances. The first, constant staffing, we took a 5-year look at this. And you can see the final budget number there, the second row there, went from 15 million in 2018-19 and it went up to 19.4 million this year. The actual costs, you can tell, have been substantially different. In 2018-19, the cost was 23 million, there's a difference of 7.5 million. Last year, we had a difference of 7.6 million. In 22-23, we're projecting a difference of just over 7 million, 7.1 million. You can see the percents over budget have varied. But it's important to note that there wasn't, this doesn't appear to be just a COVID-related matter. This is a cost that has persisted for some time. I note there, just for background and sort of by explanation, the wage savings at mid-year line, that is the figure when we are trying to figure out how to close that constant staffing hole every year, the first thing we look for is like, what are the wage savings? So you can see in 2018-19, it was almost 3.6. So we're able to use that savings to cut off about 3.5 million of that difference in 2018-19. Last year, there wasn't much there, 77,000 to use. And that was in part due to an academy that wasn't built into the final budget for 21-22 that was added in during the year. So we didn't have as many vacant positions to call on then. This year, as I mentioned before, we have about 1.4 million we can use to shift it. We will use to shift over and reduce constant staffing.
Excuse me, Dave, there were lots of numbers combined in the discussion as well as on our report, as well as what you're showing us here. And like you just said, that one in gray, the wage savings at mid-year, is that the vacant position wage savings that's discussed in the first part of our report of the written summary?
In the narrative?
Yes, sir. Narrative. Thank you.
Sure. I'm just scan it real quick to.
I think it relates to the constant staffing issue versus the actual staffing.
Well, see, I have a bunch of numbers and I'm trying to plug them in to wherever they would be on these things. Like it said, well, let's clear this one up. Wage savings at mid-year, because it's about the same. It says 1.4 million.
Yes, that would be the same thing.
Okay, well, shouldn't there be some discussion on how we want to use that? Because we're just we're at the beginning of a, what do you call it? FTE or PAD. We're at the beginning of discussions for actually adding positions here. And if this is down in the budget for positions, it seems like that would be a place to go to help fund new positions.
So the 1.4 million is for this fiscal year. The additional changes that were made to positions in this fiscal year, they are all built in. And then you have the pad there at the back of the presentation. So going forward, we will, if you're wondering about next year, 23-24, we will again follow the same practice where everything is considered, whatever positions are there, we are going to budget like they're all going to get filled.
Well, what I'm getting at is that maybe it's not right now at this time, but in the next 6 months, we need to be looking at how to pay for more additional positions here at Metro, whether they be sworn or non-sworn. And anyway, I saw some pad where you're supposed to have 35 additional paramedics, and that might be aspirational because of the recruitment issue, but still, I'd like to have a little bit clearer designation of where these funds are going to come from to pay for that. Yeah, so it said erosion of medical costs was 2.5 million, and it said workman's comp was 4.8. Overtime cost of staffing was minus 7.1 million, but then we had a savings with the some general fund savings of 2.7. And I'm adding this stuff up and it comes out in the negative. Now, maybe I can go with you offline on that, but some of the stuff in the narrative, it's not.
These are the highlight items. There are, this doesn't include the transfers in, it doesn't include all the transfers in. So these are kind of the top line and significant items.
Okay.
They are all built into the budget document itself.
Well, I'll carry on conversation.
Okay.
Director Weber, you had a question?
Yes, sir. Thank you. Can you go back to the last slide you had up where
sure.
it was showing the savings and so on the 1.49 or 19 and then the actual cost of 26.4, are those numbers put back into the actual cost? Is that what we're seeing right here on the 26.4, or are those the 1.4? Is it somewhere else still, and it needs to go back to that to show actual cost? I'm not following that point.
There are two separate line items in our labor cost page in the budget. So the 26.4 is the level we anticipate reaching by June 30th. As just as 1.4 is the level of savings we anticipate in that wage line by June 30th.
Okay, and that's again the 26.4 is the constant staffing issue you're speaking of that
Yes.
is funded but not actually being paid out?
It will be
Is that-
paid out, it's paid out monthly with wages. Oh, sure. Ken.
If I might
Please,
help
please,
out.
I'm not understanding that.
So the part of that constant staffing is the overtime that's required because those positions are vacant. So if we have vacant positions, they still are seats that need to be filled in the stations.
Right.
And so that's where the constant staffing comes in. So the savings are just an offset, if you will. If those positions were filled, there wouldn't need to be the overtime for that. So since the positions are vacant, we have to incur overtime to fill those spots. So I think what Dave was trying to say is that part of the reason for the overrun in constant staffing is those vacant positions. So at mid-year, what we typically do is say, okay, we're incurring overtime costs to fill those positions, and we can offset some of those overtime costs by those vacant, the wages and the benefits related to those vacancies.
I understand that point. Where is that being shown is all I'm trying to get at here.
Yeah.
That's the $26.5 million for actual constant staffing costs.
I too will have to talk to you later.
No,
about
excuse me, Director Weber, the answer to your question is the 1.419 is included in the 26.478?
No, they're separate categories. On the labor costs page is page 10 of the actual mid-year budget document. It lists, the very top line is wages, and it shows that there's a 1.419 savings, anticipated savings in wages by the end of the fiscal year. And constant staffing is a few lines below there. You can find the 26.
Okay. Thank you.
This 1.419 number is not factored. It's not part of this differential that we see up here between the 19, 26 and the 7.
That's correct.
It's from a different line item altogether.
That's correct.
Okay, I
And
think
the
that's-
reason I wanted to show it is because it is the kind of the go-to, where can we find some savings to offset the constant staffing, and it's the two tend to be pretty closely linked. So I wanted to present it that way, so you can see that.
I know we talked about this difference of 7.8 is going to include the 5 million plus that we got from the budget from the MOU this year. But why are we at 7.6, 7.5 million in these prior years? What's going on that we weren't forecasting well enough with final budget versus actual cost going back to 2018?
Yeah, that would, that's something that I think needs to be explored more closely. I mean, we've been saying COVID for a while, that, COVID came up, and I think that definitely did contribute to it. I mean, this year, the 7.1, at least 1.1 million of that is related to the MOU, because wages went up and the constant staff went up there. There's also workers' compensation piece that's embedded there. When you have higher workers' comp, you're going to have more constant staffing as well. But the bulk of it is, as Ken said earlier, is when we just continue to have people who are out, and we have to backfill.
And I understand how that explains this year, but we've got 4 prior years where it's kind of a consistent differential that we keep missing by the same amount. So I don't want to have 23, 24 come up at $7.5 million again, under where we're shuffling funds. What are we doing to look for patterns or reasons why we have 5 years with one anomaly of $7 million in shortfall, so that we don't keep making that same shortfall going forward?
Maybe I can, again, try and add a little more light to it. So when the district first determines its budget, as Dave mentioned, we budget all positions like they're full for 100% of the year. And so you wouldn't want to add constant staffing overtime costs for those positions. So you could either budget a less than full staffing and a higher overtime budget, or you budget full staffing and a lower overtime budget. And then at mid-year, you kind of take a look at what's actually going on. And if there's vacancies, then you can move those savings from the salaries and benefits into that overtime line to adjust. You just don't want to get in a situation where you're double counting those costs. You're double budgeting staffing and benefit costs and overtime costs to fill those positions. So between the two of them, they should balance out. But Dave's right, you have things like sick leave comes up, workers' compensation costs. So when somebody's out on workers' comp, you got to fill those spots. When you have strike team deployments, you know, that activity goes up and down from year to year. Those folks are away, you have to fill those with overtime. So all of those things come in during the year that you really, you know, don't have a good handle on or a way to project how those things are going to happen during the course of the year. So that's why we have at mid-year, we kind of take a look and see if we can balance out the two. Balance wages, benefits, and constant staffing. Because those seats have to all be filled every day. If that made it any clearer or not?
Mr. Chair, could I suggest that we have some possible dates for a workshop here, and that this discussion of a continuous difference here and how much of that's the impact because of well, cost of staffing, but how much of it is, again, we need to have more positions. We need to have more positions for the department. And that, what's the word? That kind of modeling could be a good point of discussion for our workshop, so that we can try to avoid these, well, variations or accounting variations.
I think that'd be a good idea. There's something we could put on calendar, Melissa? Sure.
Yeah.
That'd be great. We can get that done. Yeah, there's still more questions, but
Yeah.
go on, sorry.
And thank you, George. I appreciate the question. That's mainly the reason for the slide, is to draw attention to that, to the trend, and recognize it's something structural that we have to address. So
Yeah.
look forward to more conversations. The next slide is workers' comp. So again, a 5-year look. You can see in the final budget, the number hasn't changed a lot. We keep putting in around 2.1 and then 2.4 for the next 4 years. Actual costs for the first couple of years were in that ballpark, but in the last few, they've really taken off. And you can see this year, there's that 4.8 million over budget. Incidentally, you know, the solutions for this will be, the funding for this will come out of the existing budget. We are not proposing to tap the $4 million workers' comp reserve. But you can imagine there need to be, and I understand there are conversations going on about how to address these costs on a long-term basis. The next slide is non-general fund balance. Again, the 5-year look. With this, I wanted to just point out these are 3 funds that we use that have a few purposes. They are generally related to infrastructure and building infrastructure, but we've also used them for cash flow purposes. We do use them for cash flow purposes within the fiscal year to take some money out, put it back, doesn't affect the budget. And then rarely, although it happened last year, we've made transfers from these funds, the capital facilities funds and lease properties fund. You recall we made transfers of 1.1 and 1.2 respectively from those. And you can see that that the balances have of those funds went down precipitously from 21-22 to 23. So we're losing some flexibility there for the purposes I just described. With the IGT in particular, you see the 0 there. I mentioned earlier that we're using all the IGT that comes in, both VRP and PPGFT. That is, I know years ago it's been explained to me that the IGT was accruing balances for the purposes of capital facilities. And that's no longer happening. We now require that IGT to make ends meet, if you will. So that is a change. So getting to the summary, the mid-year adjustments result in a projected year-end general fund increase of 1.4 million. Key features, again, we have no budget reductions proposed. We're reflecting the new PPG EMT funding source, which is a net gain of 5.4 million. We're implementing the first 6 months of the MOU. We're restoring 1.1 million transferred from the capital facilities fund to the general fund in last year's mid-year. We're gonna put that back, and then workers' compensation reserve is untouched, but structural budget challenges persist. Your projected reserve as of June 30th is 36.1 million. That's at 13.4% of net budgeted expenditures. Compare that to the 36.1 million we had in the final budget with a 13.8% net budget expenditures. And the difference, of course, is the expenditures, the bottom, the denominator went up. So even though the amount is the same, it went from 13.8 to 13.4 projected for June 30. So that concludes my briefing. That this is a receive and file item. I welcome any other questions.
Any other questions for Mr. O'Toole? Director Weber?
Yeah, on the work comp fund that you were speaking of, what percentage is that of the budget that you have in reserve?
It is that's a good question. The workers' comp reserve is separate from the general fund reserve.
Right. What percentage of the, what monies do we have in there, I guess, is what.
4 million in the workers' comp reserve, we have $4 million.
Okay, thank you.
Yep.
That was it. Thank you.
Any others?
No, we can follow up with.
Thank you, Mr. O'Toole. Thank you. Next up, don't go far because you're next. We've got the financial report through December 31, 2022.
Okay, good evening again. Tonight's bi-monthly fiscal report covers the first 6 months of the fiscal year and is intended to help you monitor the fiscal health of the district. This presentation is drawn from the most recent Finance Committee report, which you've been provided with your agenda. We will start with the familiar and something you saw the last month, the last bi-monthly fiscal report. This is the presentation through December. As you can see at the end of November and December, the gap between last year and this year narrowed. The green line is the prior year, the red line is current year. Again, the causes, the difference is now about 7 million. And again, the causes include less available cash than we had last year, since the payment to PERS was $4 million higher than last year. Also, the starting balance for the development impact fee was lower because of Station 68 expenditures. Also, the balance transfers from the capital facilities fund and leased properties funds were made last year with a total of 2.3 million. This slide is your total revenue slide after 6 months. It shows that the district is just under general fund revenues, the budgeted general fund revenues, the blue line, which includes taxes, service charges, medic cost recoveries, and transfers into the general fund. There are 3 colored lines on this chart. The green line is prior year revenues. At the end of December last year, revenues were 129 million, as indicated on the chart there. The red line is current year actual revenues. That's 134.6 million, so 5.6 million more than last year at this point. And the blue line, budgeted revenues, as planned in the final budget, is again tracking along the same line and higher at 137.7 million, 3.2 million above actuals. Total projected budgeted general fund revenues in the final budget were 266.1 million. This is a good point to clarify and point out that after the mid-year changes, if the board chooses to adopt the mid-year budget, this will change. The 266 I show there, if you adopt the mid-year budget as we just saw, the 266 million budgeted will become 270 million. So you'll see, so the numbers will realign by that. And that is past practice. We're using the most recent adopted budget for this presentation, but for any reason you wanted to see it compared, we could provide that as well. This next, drilling down a layer into the medic cost revenues. This slide, also known as EMS revenues. As we heard in the mid-year budget presentation, revenues are not expected to come in where we had them budgeted early in the final budget. You can see that the difference is showing up after 6 months. The red line for medic revenues are nearly 22 million. We're at 22 million after 6 months. Actuals, prior years were just over that at 22.3, and our budget number was almost 23.5. So a difference of 1.5 between actuals and budgeted after 6 months. Next, we'll turn to the expenditure side of the equation. Okay, after 6 months, actual general fund expenditures relative to our final budget are about 2.7 million under budget. Actual expenditures at 134.6 million are 9 million greater than prior year expenditures shown with the green line. Expenditures through December were equal to 51.5% of the total annual expenditure budget. Turning to labor costs, that portion of expenditures. Let's see, on this slide, the blue line is again the budget, and red is actuals, and green line is the prior year. The lines are all tracking very closely, so I'll just tell you that after 6 months, labor costs were 109.6 million, tracking almost exactly with the budgeted number. Actual labor costs were 2 million more than the prior year number of 107.6 million. Again, this is the first 6 months of the fiscal year. It's before the MOU took place, so we'd expect to see a deviation after this point. Your next bi-monthly fiscal report is in April, so that's when you'd expect to see it on this particular chart. Turning to reserves, this has the green line of the prior year and the red of the actual for the fiscal year as a whole. Excuse me. We followed a course similar to last year. At the end of September, reserves were 8.3 million, lower than last year at this point. At the end of December, reserves narrowed to 2 million, lower than last year, and stood at a positive 37.3 million. So the gap had narrowed. If this rate were to continue, our end of year balance would be 15%. You can see the green line intersecting with the yellow at the top at the far right there. But as we heard, with the additional costs of the MOU, constant staffing, et cetera, our reserve is more likely to be 13.4%. That's the reserve picture. This next slide is the CERT fund as of December 31, 2022. CERT stands for California Employers Retirement Benefit Trust. Important to note, this is not a cash fund. Monies in this trust can only be used to pay for future OPEB benefits and mainly retiree health premiums. The total at the top, 67.2 million, is 2.6 million more than the last bi-monthly report, so we're trending upward. It's made up of contributions over the life of participation in the fund and investment earnings. Since inception, the district has contributed 54 million of that. And as you can see in the green area to the right, earnings are picking up again in this report, but not reaching the level attained in the summer of 2021. So that's at the far right, you can see that it's starting to pick up again in our earnings. With an overall liability of 263.2 million for 22-23, that's our OPEB liability. We're about 25.5% funded. So short of the 26% peak we reached a couple of years ago. Last year, I should say. Our CERT fund balance is still 3.3% lower than where we started this fiscal year, but that gap is narrowing. That's the CERT update. So your report takeaways, let's see, after 6 months of this fiscal year, the general fund cash trending is somewhat lower than last year by 7.4 million at the end of December. That seems to be a narrowing trend. General fund revenue is 3.2 million lower than what we had in final budget. General fund expenditures is 2.7 million lower than final budget. And our CERT performance improved. It's now 25.5% funded. Catch my slide up there. So those are the key takeaways again for the bi-monthly fiscal report through December 31. This is a presentation item only, and I welcome any questions.
Director Jones, you.
No, could you just put up that last slide for just a few more seconds, please? Thank you. Thank you, Director. Okay. General fund, that's the 2.7 that was discussed, and serve at 25%. Lower than final budget. The revenue was lower and the spending was lower.
Exactly.
But there's still a 0.5 difference in the general fund then, is that correct?
Well, the
It says revenue
the
is
net-
3.2, I'm sorry, go ahead.
Sure, as of the end of December, yeah, that was the net difference is 500,000 there between the two.
Thank you. Just was reading it too slow.
I had
Thanks.
to keep up on my slides.
Thank you.
Director Weber?
No, thank
Oh,
you.
I'm sorry. I thought, saw your hand. All right, well, thank you, Mr. O'Toole. And you got one more with us, the
I do.
overview of the Finance Division Internal Control Procedures and Practices.
This is a special one. Okay.
Welcome.
Thank you. When the slide comes up, this presentation, internal controls update, it's intended to convey the district's efforts to follow and keep current on internal controls practices. This is informational. We consider in finance internal controls to be an established work in progress, which means we should have institutionalized in our day-to-day activities, sound financial practices, as well as anticipate that the threat is constantly changing and try to keep up with it. So here's the topics I'd like to cover. First, we'll introduce internal controls. And we'll talk about the internal auditor's responsibility, the independent auditor's responsibility. We'll talk about finance division's role, and then any next steps and questions. Okay, with this, I wanted to start with a recent example of why internal controls matter. This slide here is, you can see the fraudulent stamp across it. This is an actual solicitation. What this letter is, it's from a vendor who we use, who on our workers' comp insurance related activity, we make payments. And what this letter is saying is appears to be from Sedgwick, and is saying, oh, we've changed our bank account numbers. Please, send your payments this way. It's a very common fraud now. But I received this as an email warning on Tuesday. So it's very recent. We never actually received the letter, or haven't received it yet, I should say. But they alerted us to it, and I wanted to just draw your attention to that. Provide some assurance. Had we received this letter, we do have practices in place. We have a designated contact at Sedgwick, and we would contact this person and say, did you in fact ask us to change your routing numbers? And we additionally we send the request to purchasing, and they review it as well. Purchasing sends it to the county. The county will prepare a form that would go to Sedgwick for them to review. The county would validate the account numbers and that the account itself was valid. So between us and the Sacramento County, we have a few checks to catch this kind of thing. But it is not an uncommon scam, I'll say that. So what is internal control? Let's see. Internal control is a process concerned with the stewardship and accountability of resources while striving to accomplish the district's mission with effective results. And that's our official definition. Internal controls can be expected to provide reasonable assurance, but not absolute assurance. Internal controls can be overridden by collusion. You could have a couple of people working together in an organization to overcome internal controls. I mean, that is a real risk, and I will talk about some of the preventative measures that finance takes with that regard. So, why are internal controls important? They do matter. On this slide, we identified 4 principal purposes for internal controls. First is ensuring the use of resources are consistent with laws, regulations, and policies, safeguarding assets against waste, loss, and misuse. Of course, facilitating relevant, reliable financial information. We use internal controls for that, such as the annual comprehensive financial report we'll be reviewing later in the board meeting. And last, supporting the achievement of the district's mission. It's important that internal controls be part of that as well. The slide sums up the purpose of internal controls and why they matter. So what happens when they are weak, when your internal controls are weak? Well, we listed several items here. So erroneous management decisions based on erroneous, inadequate, and misleading information. You may encounter fraud, embezzlement, and theft by management, employees, customers, vendors, the public at large. You have business interruption. You can have system breakdowns and excessive rework to correct errors. There could be statutory sanctions, which would be penalties arising from the failure to comply with regulatory requirements, as well as overt violations. And the cost of fraud cannot always be measured in dollars. Sometimes it's a matter of eroded public confidence. Earlier, I gave an example from Sedgwick and what they had and the fraud letter that we had received from them. Another example from just last fall, it was last October, was an individual named Rhonda Kish of Oramel, New York. She was the treasurer for a local fire district there. From 2016 to 2020, she stole $8,675 from that fire department by making unauthorized cash withdrawals and writing checks to herself with supposed reimbursements that had no receipts or approval. She worked in concert with a relative who was a secretary, first assistant chief at that department. And the scheme unraveled when the board began to look into, well, where are the receipts for this? And it's a small fire department, but they looked into it and began to unravel, and they face prosecution. So key internal controls at Metro Fire. We're going to list 5 here. So segregation of duties. The person handling mail cannot endorse checks, and another person deposits checks, and still another person reconciles the deposits to the records. Authorization control. So we use public budgets. We require approval of invoices, and significant ACH wires, as I mentioned before, require dual approvals. Security of assets. We external ACHs that hit our banks require approvals by the controller and the payroll supervisor as applicable. So finance staff have to actually verify that it's okay to pay. We have reconciliation and review. We have preparation of analysis of financial statements, helps to verify accuracy, completeness, and compliance. So the bi-monthly fiscal report is an example of a review document. And then documentation. Documentation preserves evidence and the audit trail. Every step of the invoice process is captured and recorded in Oracle, our resource system for accounting transactions, which keeps an audit trail itself. We also have written down policies and procedures, of course. So these are the 5 principal internal controls used by Metro Fire. Now to talk about the independent auditor's responsibility, as I mentioned earlier, we rely on third parties as well to provide internal controls. This slide describes our internal auditor's responsibilities. Incidentally, she will be with us tonight to present the ACFR, and she's been asked to talk a little bit about internal controls there too. So she will include that in her presentation. But briefly, the independent auditor scope spans from account reconciliations to performing inventories to ensuring an adequate segregation of duties. She reports to the board significant deficiencies and material weaknesses, et cetera. The internal control, the independent auditor also attests the district's compliance with our regulations and laws and grant agreements. And a couple of other pieces to note too, just historically with the department. In 2012, our external auditors identified 18 audit issues related to internal control. By 2014, all the issues were resolved and recommendations were implemented. And since 2014, we've had no internal control findings, including the report tonight. Finance division's role. So internal control is affected by the people. It definitely starts with the tone at the top. And again, I appreciate the request to make this presentation because I appreciate the opportunity to be able to talk to the Finance and Audit Committee about these. Executive leadership must demonstrate commitment to integrity and ethical values, of course. They establish the structure, oversight, and responsibilities, and they enforce accountability. This past August, finance staff committed 8 hours to Cal CPA training called Financial Fraud and Internal Controls Update. It's also a regular topic at our staff meetings. But as you can see there, finance management assesses business risk through active and direct involvement in daily operations and is committed to competence. It includes that ongoing staff training in an annual training plan. One final piece of internal control and finance division management I want to draw special attention to is Ron Empedrad right there. He may not relish the spotlight I'm about to place on him, but I do want to mention his background and of recent success. Ron is a 10-year, spent 10 years as our controller here. He's been here for 10 years. Prior to that, he was in the auditing world for local government agencies, doing the kind of internal control audits we're going to hear about tonight. He did that for 10 years previously. Also, he's a certified fraud examiner. And not only that, when he took this certified fraud examiner test in 2020, which is a national exam, he got the highest score in the entire country.
All right,
Excellent,
Ron, way to
Ron.
go.
Yes.
Congratulations.
Why aren't we just hearing about this 3 years later?
Yeah, I know. I just found out last week.
That's awesome.
He was awarded the Morris R. Red Walker Award from the Association of Certified Fraud Examiners, given to the person who received the highest annual score on the CFE exam. That's Ron. Congratulations, Ron.
Wow.
Didn't know that was coming.
Wow.
So, excuse me. Before turning to questions, I just want to mention one more thing. The Finance Division is developing a district-wide risk assessment, which would go a layer deeper than we typically do with our internal controls, examining policies, procedures to look at new risk areas. It is the kind of thing that a CFE like Ron would come up with, and we will complete that in 2023. We'd be glad to come back to the committee and report results as well. That concludes my internal controls briefing. Are there any questions?
Any questions for Mr. O'Toole?
No, sir.
I have just two real quick questions. Just for edification, is there anyone that, you mentioned the auditor has made recommendations in the past and we've been clean ever since 2024, which is great. Does the auditor look at our controls and make sure that they are appropriate? One, and two, is there any standard best practice, anything like that we are compared to?
So I could answer that a couple of different ways, but Ron, do you want to come up and help with that? So, standard best practices may be the annual comprehensive financial report itself. Like, we do submit that for evaluation by the Government Finance Officers Association, so we're looked at that way. In terms of the procedures, I would probably turn it over to someone who's actually done it to answer that.
So to answer your question, Director, the auditors do perform tests of controls for our accounting system, and they only do that in connection with their audit of our financial statements. They don't actively they don't provide us an absolute assurance that yes, we've audited your controls, and we guarantee. They do not provide any kind of guarantee. They only provide a reasonable assurance that yes, we've looked at your controls, and they define this concept called reasonable assurance. It's what a prudent person would expect to find in the course of an audit. So it's not an absolute guarantee, which is why our internal controls, as Dave mentioned in his presentation a while ago, is that we do not provide absolute assurance, just reasonable assurance. So the auditors do, as part of their procedures, they do look into our controls, and as they'll be reporting in the next meeting, they'll be reporting about the results of that controls. And just to preempt them, they did not find any issues or findings, and they do present that in a formal report to the board. You'll be getting a couple of reports from them, governance letter that discusses what their responsibilities are, and then the results of the audit, and an internal control report letter. I asked them to highlight that portion of their report in the full board meeting.
Thank you. Appreciate that, Mr. Emperor. Any other questions?
No, sir.
Thank you so much, Mr. O'Toole.
Thank you.
Okay, our next meeting date will be April 27, 2023. We are not going to have a committee meeting in March. And so we will next meet on April 27, 2023. If there's any anticipated action or items, get them to the board clerk so she can get them on the agenda. And we will adjourn until then.
Thank you, Mr. Chair.